Yes, good morning, good afternoon, good evening to all South India student. How are you? Hope so you are good. I am also good. First, I want to say sorry to all of you for delay in the revision lecture. From last 25 to 30 days, I was not well because I got one minor fracture, and due to that I was not able to record the revision lecture for all of you. But don't worry, now I will give you the revision lecture as I promised you earlier. So today we are going to start with the revision of very important topic, that is the profit or gain from business or profession. We call it PGBP. First section of PGBP is a section 28. Section 28 is a basically charging section. This section is saying that following income will be taxable under the head PGBP. First clause of section 28 is saying that any profit or gain arising from business or profession carried on by SSC at any time during the previous year will be taxable under the head PGBP. That is the normal clause. Now next point is saying that suppose against export, if you receive any subsidy or cash compensatory support against export, that cash compensatory support or subsidy will be taxable under the head PGBP. Now try to understand, whenever you export the goods, then obviously at the time of manufacture you pay the excise duty or GST, and at the time of export you pay the custom duty. Suppose if you receive the duty drawback of that duty, then that duty drawback will be taxable under the head PGBP. Now instead of duty drawback, if you receive the DEPP, that is duty entitlement passbook or duty exemption passbook, or DFRC duty free replenishment certificate, and if you transfer the DEPP or DFRC, and if there is any profit on the DEPP and DFRC, that will be taxable under the head PGBP. Next clause is saying that suppose against export, if you receive the import entitlement license and you don't need that import entitlement license, and if you transfer that import entitlement license to someone, and if you receive any money against the sale of import entitlement license, that will be taxable under the head PGBP. Now next point, if due to business and profession, if you received any gift or perquisite or benefit, due to business and profession, if you received any gift, benefit or perquisite, that will be taxable under the head PGBP. So suppose if you receive any gift from your client or from customer or debtors or creditor, whatever you receive the gift or perquisite or money or benefit, that is whether it is convertible into money or not, that will be irrelevant. Whether you can convert into money or not, that is irrelevant. It will be taxable under the head PGBP. Now try to understand, if any partner received any salary, commission, bonus, even interest, any partner received any salary, commission, bonus, even interest from partnership firm, that will be taxable under the head PGBP, because partner is not an employee of the partnership firm. Partner is basically part owner. So whatever received by partner will be taxable under the head PGBP in hands of the partner. Now next point is saying that suppose if you received any non-compete fees, non-compete fees means if you receive any consideration for not carrying out any business and profession, that will be taxable under the head PGBP. Or suppose if you received any consideration for not sharing of know-how, patent, copyright, trademark, franchisee, design, formula, then that will be taxable under the head PGBP. Now try to understand, if you received any amount from the keyman insurance policy, if you receive any amount from the keyman insurance policy, including the bonus on that keyman insurance policy, if it is received by employee, then it will be taxable under the head salary. If it is received by employer, then it will be taxable under the head PGBP. And suppose if there is no employee-employee relationship and any person received the compensation, or you can say that any amount from the keyman insurance policy, that will be taxable under income from other sources. So if any businessman, or I can say that any employer received any compensation on the keyman insurance policy, that will be taxable under the head PGBP. So if it is received by employee, taxable under the head salary. If it is received by employer, it will be taxable under the head PGBP. And there is no employee-employer relationship, then it will be taxable under income from other sources. You got my point or not? Yes. Now try to understand, if your stock in trade is converted into capital asset, if your stock in trade is converted into capital asset, and on the date of conversion, whatever fair market value of that stock in trade, that fair market value will be taxable under the head PGBP. Means in case of the conversion of stock in trade into capital asset, at the time of conversion, whatever fair market value of that stock, that will be taxable under the head PGBP due to section 28. Now next part, suppose if there is any business contract, and there is a modification or termination of that business contract, and due to termination or modification, if you received any compensation, that compensation will be taxable under the head PGBP. That compensation will be taxable under the head PGBP. So this is all about the section 28. So 28 is saying that following income will be taxable under the head PGBP. All people must pay attention. First clause is any profit or gain arising from business or profession carried on by SSC at any time during the previous year will be taxable under the head PGBP. Against export, if you receive any cash compensatory support, or against export if you receive the duty drawback, or against export if you receive the import entitlement license and you sell the import entitlement license, that will be taxable under the head PGBP. Due to business profession, if you receive any gift, any perquisite, any benefit, whether it is convertible into money or not, that will be taxable under the head PGBP. If partner receive any salary, commission, bonus, remuneration, even interest from partnership firm, that will be taxable under the head PGBP. If you receive the non-compete fees means if you receive any compensation for not carrying out any business or profession, that will be taxable under the head PGBP. Or not sharing of any know-how, patent, copyright, trademark, franchise, design, formula, that will be taxable under the head PGBP. If there is any business contract and there is a termination or modification of terms and condition of that business contract, and if you received any compensation for that, then that compensation will be taxable under the head PGBP. If employer received any sum from the Keyman insurance policy, that will be taxable under the head PGBP. That will be taxable under the head PGBP. And in case of the conversion of your stock in trade into capital asset, at the time of conversion, whatever FMV, that FMV will be taxable under the head PGBP. Now, this section is saying that always you have to treat the normal business and speculative business separately. Why it is? Because speculative business loss can be set up only against a speculative business income, and speculative loss can be carried forward only for the 4 assessment year. Now question is that, sir, what do you mean by the speculative business? So here speculative business means business in which ultimate settlement of any transaction is through any mode other than actual delivery. Means actual settlement of that transaction will be by any mode other than actual delivery, means there will be no actual delivery of any goods or script or share. In that case, that is called your speculative transaction. I can take an example of the intraday. Suppose you purchase the share in the morning, you are going to get the delivery only T+2, but you sold that share in the evening, that is called intraday. So in case of intraday, that is known as the speculative business. But guys, try to understand, all people, there are 4 transactions. There are basically 5 transactions. This 5 transaction is look like speculative, but it is not a speculative. These 5 transactions are look like speculative, but it is not a speculative. First transaction, if there is a hedging contract in related to your raw material and merchandise. Suppose if you are going to take any hedging contract and you are hedging the risk of price fluctuation of raw material and merchandise. So if there is a hedging contract of the raw material and merchandise, or hedging contract of share and security, or any forward contract, or any derivatives in the share and security, or derivative of the commodity, this 5 transaction are looks like a speculative, but law is saying that this transaction are not treated as a speculative, and if there is a loss due to this 5 transaction, that will be treated as normal business loss only, and this loss can be carried forward for the 8 years, and this loss can be set off against any other head income except the salary income. You got my point or not? Yes. So all people, please pay attention. A speculative transaction means transaction in which settlement of that transaction by any mode other than actual delivery. Now what do you mean by the speculative business? That we already discussed. Now speculative business means speculative transaction is transaction in which the actual settlement will be by any mode other than actual delivery. There is no actual delivery, that is called a speculative transaction. Now this 5 transaction is look like a speculative transaction, but it is not treated as a speculative transaction. This 5 transaction will be treated as normal business transaction only. First part is related to hedging contract in relation to the raw material merchandise. Second transaction is related to hedging of the shares and security. Third is your forward contract. Fourth is your derivative in share and security, and fifth is your commodity derivative. But in commodity derivative, there is a condition that CTD should be paid. CTD means commodity transaction should be paid. But in case of the agriculture commodity, CTD is not applicable. Then also lawmaker made the amendment, and lawmaker is saying that in case of agriculture commodity also, even if there is no CTD, then also it is not treated as a speculative transaction. Now we are going to start with the section 29. 29 is saying that how to compute the PGBP income. There is no use of this section. This section is saying that PGBP income has to be computed according to the section 30 to 43D. You have to just follow section 30 to 43D. You are going to get your PGBP income. Now next section is a section 30. Now section 30 to 37 is related to the expenditure section. Means this section is saying that which expenses is allowed under the head PGBP. So first section is section 30. Section 30 is saying that rent, rates, taxes, insurance and repair of building. Rent, rates, taxes, insurance and repair of building. Rent, obviously to owner it is not allowed, but if you are a tenant of any building, then rent is allowed. But rates, taxes, insurance and repair is allowed to the owner as well as the tenant. But try to understand, in repair only current repair is allowed. Current repair means revenue repair is allowed, capital repair is not allowed. So section 30 is related to the rent, rate, taxes, insurance and repair of the building. So rent is allowed to the tenant, rates, taxes, insurance and repair is allowed to the both the tenant or owner. Now next section is 31. 31 is saying that insurance and repair of plant and machinery and furniture. So if you spend anything on the insurance and repair of the plant and machinery, furniture, it is allowed as deduction. Now try to understand insurance and repair. Repair means here also current repair only, revenue repair is allowed. Now question is that, sir, if rent of plant and machinery is allowed or not? Rent of plant and machinery, furniture is allowed or not? Obviously to owner not allowed, but tenant allowed. But it is allowed due to section 37, because in section 31 they mention only insurance and repair of the plant and machinery, furniture. Now we are going to start with the very important section, that is the depreciation. Section 32. Now question is that depreciation is allowed if two conditions are satisfied. First condition, assessee should be the owner of that asset and that asset should be used for your business and profession purpose. Owner means registered owner or beneficial owner. Right answer is beneficial owner. There is a Mesur Minerals case law, and as per various case law they are saying that you should be the beneficial owner of asset. There is no need of the registered owner. Now if you are partly own any asset, suppose one asset of 1 crore 50 lakh is invested by me, 50 lakh is invested by you, can you claim the depreciation on 50 lakh? Answer is yes, you can claim the depreciation on 50 lakh. Since that asset is partly owned by you, then also you can claim the depreciation. Since asset suppose partly owned by me, so I can claim the depreciation on partly owned asset. Now question is that in case of hire purchase, you become the owner only after the payment of last installment, but you can claim the depreciation from the beginning. Now in case of the lease, who will claim the depreciation? So in income tax, depreciation has to be claimed by the lessor, whether it is an operating lease or financing lease. Whether it is an operating lease or financing lease, depreciation always be claimed by the lessor. Why it is? Because if depreciation is allowed to lessee, then lessee is going to take the double deduction. One lessee will take the deduction of the lease rent and second depreciation, so obviously double deduction is not allowed. That's why in income tax, depreciation is always claimed by the lessor. Always claimed by the lessor. Now what do you mean by the use? Use means active use or passive use. Now what do you mean by the passive use? Passive use means asset is your intention is to use the asset, but that asset you will use only at certain condition is fulfilled. That is called passive use. We can take an example of the fire extinguisher. In case of the fire extinguisher, you know that in the whole year, suppose there is no fire, so fire extinguisher will not use. Question is that can you claim the depreciation or not? Answer is yes, that is called your passive use. Or I can say that in your school, suppose one school is engaged in the business and school is having the 5 buses. They are running the 4th buses, but 5th buses in the spare. Like suppose if there is a breakdown of any bus, then they are going to use the 5th bus. So question is that can you claim the depreciation on all 5 buses? Answer is yes, you can claim the depreciation on all 5 buses. Now question is that depreciation is allowed from the date on which asset is actually put to use or ready to use. Right answer is put to use. Depreciation is allowed only from the date on which asset is actually put to use. Now classification of depreciable asset, there are basically 4 class of asset. One is the building, second is furniture, third is a plant and machinery, and fourth is the intangible asset. One is the building, second is a furniture, third is a plant and machinery, fourth is a intangible asset. Building means like if any structure, and you can call that structure as building, that is called building. But try to understand, temple is also included in the building. If road constructed in the factory, that is also included in the building. Furniture include your electricity fitting. Suppose there is a wires or switchboards and all, like that is also included in the furniture. Now intangible asset means, intangible asset include the goodwill, patent, copyright, trademark, franchise, design, formula, that is all included in the intangible asset. Now try to understand, goodwill also treated as intangible asset. If you purchase the goodwill, you can claim the depreciation on that goodwill. Next part is a plant and machinery. So plant and machinery means your bike, car, mobile phone, that is called plant and machinery. Or camera is a plant and machinery. iPad is a plant and machinery. My laptop is a plant and machinery. Now question is that plant and, here all people please pay attention, plant and machinery also include the books. Books is specifically included in plant and machinery, as well as the surgical equipments are treated as plant and machinery, but from plant and machinery they have excluded the animals or livestock. So basically animals or livestock is not a plant and machinery, as well as the tea bushes is also not a plant and machinery, and furniture and building is not a plant and machinery, because furniture and building, they are having the separate class of asset. So basically I explained that there are 4 class of asset. One is the building, one is the furniture, one is the plant and machinery, one is the intangible asset. Now what is the rate of depreciation? So in case of the building, if residential building, then rate of depreciation is 5%. Other building rate of depreciation is 10%, but temporary building rate of depreciation is 40%. Furniture rate of depreciation is 10%. Now intangible asset rate of depreciation is 25%. For intangible asset asset, rate of depreciation is 25%. But now try to understand in case of the plant and machinery. So in plant and machinery, suppose if there is a motor vehicle. So in case of the motor vehicle, your depreciation rate is 15%. But if that motor vehicle is used for hiring business, then your depreciation rate is 30%. But try to understand, if motor vehicle is acquired and installed between 23rd August 2019 till 31st March 2020, acquired and put to use. What I am saying that if your motor vehicle is acquired and put to use between 23rd August 2019 till 31st March 2020, then in normal cases your depreciation will be 30% and hiring business 45%. In case of ship, your depreciation is 20%. In case of aircraft, your depreciation is 40%. In case of computer software, depreciation is 40%. In case of the pollution control equipment, depreciation is 40%. In case of books, depreciation is 40%. In case of windmills installed before 1/4/2014, then depreciation was 15%, but windmills installed on or after 1/4/2014, your depreciation is your depreciation is 40%. Earlier it was 15%, 1/4/2014, on or after, depreciation rate is 40%. Now try to understand, in case of the oil wells, your depreciation rate is 15%. Now depreciation is mandatory, you have to claim the depreciation. Depreciation is basically mandatory. Now try to understand mobile phone and EPA-BX. EPA-BX is basically an intercom calling system in the fact companies and all. Whenever you dial there, they said that for 9 operator press 9 and for 1 and all that. That is called EPA-BX. So in case of the EPA-BX and mobile phone are not computer, you can claim the depreciation only at the rate 15%. But try to understand, suppose there are any part of computer means computer accessories like UPS and printer and all, on that you can claim the depreciation at the rate 40%. You can claim the depreciation at the rate 40%. Next part is the method of depreciation. So basically there are two methods, one is the SLM method, one is the WDV method. SLM method can be claimed only by the power generating and distributing unit. So if any assessee is engaged in power generation and distribution business, that person has the option to claim the SLM or WDV, but all other assessee, they have to follow only WDV system. So 99.99999% assessee don't have the option, they have to follow the WDV method. Now there are two types of the system to claim the depreciation. First system is a individual asset system. Individual asset system means system same you have followed in the account or FR. That is called individual asset system. You have to calculate the depreciation and profit and loss on single asset. That is called your individual asset system. Now individual asset system is applicable only if you follow the SLM method, and SLM method can be followed only by the power unit. But for other assessee, means assessee follow WDV method, that assessee is subject to the block of asset system. Now question is that what do you mean by the block of asset? Block of asset means group of asset. You have to make the group of asset having same rate of depreciation in same class of asset. Means class also same and rate also same. For that asset, just make one group, that is called your block of asset system. Now question is that how to compute the depreciation? All people just pay attention. In block of asset system, if you follow WDV system, how to calculate the depreciation? First take the opening WDV of block. In that opening WDV, just add actual cost of asset acquired during previous year. Actual cost of asset acquired during previous year, in simple word I can say that the purchase. Just add the purchase, that is actual cost of asset acquired during the previous year, and add by three line. Always add in three part. One is the asset acquired and put to use for 180 days or more, asset acquired and put to use less than 180 days, asset acquired but not put to use, minus money payable for the sale, discard, demolish, destroyed of a asset or any scrap value or any insurance compensation, that will be reduced. In simple words, selling price will be reduced. Now whatever remaining, that is called your WDV for depreciation. In that WDV for depreciation, first take the asset acquired and not put to use. So if asset is acquired and not put to use, so obviously depreciation is not available. Asset acquired and put to use for less than 180 days, half rate of depreciation is available, and on the balance asset, full rate of depreciation is available. On balance asset, full rate of depreciation is available. All people just pay attention. What I am saying that if any asset is acquired during the previous year, and put to use for less than 180 days in that previous year, then depreciation is restricted to 50%, or I can say that 50% depreciation is available. But this 50% condition is not applicable when asset is acquired in current year and put to use in next year. What I am saying that this 50% restriction is available only in the year in which asset acquired is put to use. So suppose if asset is acquired in current year and put to use in next year, then full rate of depreciation is available in next year. Even in next year, asset is used for less than 180 days. Now try to understand, Sir, question is that in case of the amalgamation, demerger or succession, succession means partnership firm to company, proprietor to company or small company to the LLP. So in case of the succession and amalgamation, sir, in the year of succession and amalgamation, who will claim the depreciation? So here lawmaker is saying that if there is an amalgamation, demerger or succession, then first calculate the depreciation on the assumption that there is no amalgamation, demerger and succession, and after whatever depreciation came, that depreciation has to be divided between predecessor, amalgamating and demerged company and successor amalgamated and resulting company in the ratio of number of days asset used by that. What I am saying that in case of amalgamation, demerger and succession, just calculate the depreciation on the assumption that there is no amalgamation, demerger and succession, and whatever depreciation you computed, that depreciation has to be bifurcated between predecessor and successor in the ratio of number of days asset used by them, in the ratio of number of days asset used by them. Now next part, all people just pay attention. Section 50, this section belongs to the capital gain topic. Now question is that suppose you are having the block of asset system and you are having the block, and if you transfer any asset, then capital gain, when capital gain is applicable. So guys, there are two parts. Capital gain is applicable only in two cases. First, if your whole block of asset is transferred. Your whole block of asset is transfer means block cease to exist, all asset of the block are transfer. If all asset of the block are transferred, then there will be a short-term capital gain or short-term capital loss. If your sale price is more than opening WDV plus purchase, then there will be a short-term capital gain. If your sale price is not more than opening WDV plus purchase, then there will be a short-term capital loss. So in simple word, I can say that if your block is ceased to exist, block cease to exist means whole block of asset are transfer, all asset in the block are transfer, then there will be either short-term capital gain or short-term capital loss. If your sale price is more than opening WDV plus purchase, then there will be a short-term capital gain. If your sale price is not more than opening WDV plus purchase, then there will be a short-term capital loss. But now try to understand, if you transfer the sum asset of the block, if you transfer the sum asset of the block, then capital gain is applicable only in one case. If you transfer the sum asset of the block, capital gain is applicable only in one case, if sale price of that sum asset is more than your opening WDV plus purchase. If sale price of that sum asset is more than opening WDV plus purchase, then only capital gain is applicable. Otherwise, capital gain is not applicable. Next section is section 32, subsection 1, clause 2 is related to additional depreciation. Now, additional depreciation means extra depreciation. Additional depreciation is available to only for assessee if assessee engaged in manufacturing business, or assessee engaged in the power generation business, or assessee engaged in power distribution business or power transmission business. So additional depreciation is allowed only to for assessee, manufacturing business, power generation, power distribution and power transmission. Now try to understand, additional depreciation is allowed only to the plant and machinery, not on building, not on furniture, not on intangible asset, only for the plant and machinery. And plant and machinery also second hand, on second hand plant and machinery, additional depreciation is not allowed. If plant and machinery is used in the office premises or residential accommodation, additional depreciation is not allowed. If plant and machinery is in the nature of the vehicle, ship and aircraft, additional depreciation is not allowed. Or if plant and machinery on which 100% deduction under the head PGBP is allowed in the single year, on that plant and machinery also additional depreciation is not allowed. So what I am saying that plant and machinery, additional depreciation is allowed only for plant and machinery, but plant and machinery exclude the second hand plant and machinery used in the office premises or residential accommodation, plant and machinery on which 100% deduction already allowed under the head PGBP, or plant and machinery include the ship, aircraft or your road transportation vehicle, on that additional depreciation is not available. Now question is that what is the rate of additional depreciation? Here additional depreciation rate is the 20%. And this 20% is allowed only in the year in which asset first actually put to use. So suppose you acquire the new plant and machinery current year and you put to use in current year, then 20% additional depreciation is allowed in the current year. Next year, suppose you acquire the another plant and machinery, then on that another new plant and machinery 20% depreciation will be allowed in the next year. Now try to understand, if plant and machinery acquired in current year and put to use for less than 180 days in same year, in that case that additional depreciation put to use less than 180 days in same previous year, then that additional depreciation rate will be 10% in current year and 10% in the next year. 10% in current year and 10% in the next year. Now additional depreciation is allowed on actual cost, whatever actual cost of that plant and machinery, on that actual cost additional depreciation is allowed. Now try to understand, in case of if any assessee is engaged in manufacturing business, all people just pay attention. if any SSC engaged in manufacturing business and he started the manufacturing business on or after 1/4/2015 in the notified backward area of the Andhra Pradesh, Bihar, Telangana, West Bengal. What I am saying that any person engaged in the manufacturing business, he started the manufacturing business on or after 1/4/2015 in the notified backward area of the Andhra Pradesh, Bihar, Telangana and West Bengal, then additional depreciation is allowed at the rate 35% instead of 20%. Your additional depreciation is allowed at the rate 35% instead of the 20%, and suppose put to use less than 180 days, then 17.5% in current year and 17.5% will be in next year. Now try to understand this additional depreciation is 35% is applicable only if the asset is plant and machinery is acquired and installed between 1st April 2015 till 31st March 2020. 1st April 2015 till 31st March 2020. So in simple word I can say that this is the last year of this particular provision. Now next point is related to the actual cost. Sir, in block we add the asset by actual cost of the asset acquired during the previous year. Question is that what do you mean by the actual cost? So in simple word, actual cost means whatever your purchase price, that is called your actual cost. But in that actual cost, if there is any installation charges you have to add, if there is any transportation charges you have to add, suppose if there is any trial run expenses you have to add, if taxes and duties paid on that asset, then is tax will be capitalized or not? If SENVET credit, or I can say that input tax credit is available, then it will not be capitalized. But suppose input tax credit is not available, then you have to capitalize that taxes also. Suppose asset is acquired out of the loan money. You took the loan from bank and you acquired the asset from that loan. Now question is that is interest will be capitalized or not? So always remember that up to the date on which asset is actually put to use, up to the date on which asset is actually put to use, till that date interest has to be capitalized, and after that that interest is allowed as a revenue expenditure. Suppose you got any like a government grant, then that government grant will be reduced. Government grant, if you receive from government, that government grant will be reduced while calculating your actual cost. Suppose if you if you produce any trial run product and if you sell any trial run product, then whatever recovery of that trial run product will be reduced from the actual cost. Now try to understand very interesting part. If any asset is acquired and in relation to that asset, if you made the payment to a single day in a single person in a single day more than 10,000 by cash, then it is not forming part of your actual cost. So in simple word I can say that if any payment is made towards the asset or in relation to that asset to a single person in a single day more than 10,000, then it should be made by the account pay check, account pay demand draft, any mode of electronic clearing system through bank account, or any other electronic made as may be prescribed. Now in section 43(1) there are lots of explanation, there are various explanation in different scenarios what will be the actual cost. So all people just pay attention. First explanation is related to, because suppose if any asset, earlier that asset were used in your scientific research laboratory, asset were using in scientific research laboratory, and suppose you have completed that research and now you are bringing that asset, you brought that asset in your normal business. So question is that what will be the actual cost in your normal business? When you will add that asset to your block of asset, your actual cost will be nil, because 100% deduction is already claimed under section 35. So now your actual cost will be nil. So explanation number 1, all people just pay attention. Explanation number 1 is saying that suppose an asset that was used earlier for the scientific research purpose, now you are bringing that asset into your business, your actual cost will be nil because you already claimed the 100% deduction under section 35. Now next explanation is explanation number 1A. Now explanation number 1 is saying that suppose your stock in trade is converted into capital asset. Your stock in trade is converted into capital asset, and now this capital asset is you are going to use for your business purpose. We can take one example. Suppose DLF is a real estate, they are engaged in the real estate business. They are having the various offices as a stock in trade. Suppose one office is converted from a stock in trade to the capital asset, and now they are using that office for their business purpose. So now question is that what will be the actual cost? So here actual cost will be the FMV as on the date of conversion. Means whatever FMV which was taxable under section 28, that same FMV will be treated as actual cost for the purpose of the block of asset. Means you have to add by that FMV. Now explanation number 2 is saying that suppose you received any asset as a gift or will or inheritance. Suppose you received any asset as a gift, will, inheritance, what will be your actual cost? Actual cost will be cost to the previous owner minus depreciation actually allowed to him. Cost to the previous owner minus depreciation actually allowed to him. Suppose previous owner was using that asset for the personal purpose, then obviously depreciation was not allowed to the previous owner. Then whatever actual cost to the previous owner, that directly will be your actual cost. You got my point or not? Yes. So what I am saying that explanation number 2 is saying that asset is received as a gift or will or inheritance. Your actual cost will be the actual cost to the previous owner minus depreciation actually allowed to him. Now explanation number 3. Explanation number 3 is saying that suppose if you acquire any asset at higher value. Suppose you acquire any asset at higher value and your main intention to acquire asset at higher value to reduce the income tax liability by claiming the depreciation on enhanced cost. In that case, your actual cost will be determined by assessing officer with the prior approval of the joint commissioner. Now, explanation number 4 is saying that suppose you were the owner of any asset, you were using that asset for the business purpose, and you transfer that asset, and after some time suppose you reacquire that asset from same person, or directly or indirectly you reacquire that asset, then what will be the actual cost in case of the reacquisition? Explanation number 4 is saying that in that case your actual cost will be the WDV at the time of original transfer, WDV at the time of original transfer or reacquisition cost, whichever is lower, WDV at the time of original transfer or reacquisition cost, whichever is lower. Next explanation is explanation number 4a. Now explanation number 4a is saying that suppose you acquired any asset, and lease back to the same person. You acquired any asset and lease back to the same person. In that case, your actual cost will be the WDV of the seller. WDV of the seller will be your actual cost. Now, explanation number 5 is saying that suppose if any building which was used by you for your personal purpose or any other purpose, and now you are bringing that asset into your business, what will be your actual cost? So here your actual cost will be whatever your actual cost of that building minus notional depreciation. You have to reduce the notional depreciation for the year for which you were not used that asset for your business purpose. You have to reduce the notional depreciation, but notional depreciation shall be calculated by the rate on the date on which asset is brought into your business. So suppose today you are bringing that asset into your business. So today what is the depreciation rate on building? That is 10%. So you have to reduce the notional depreciation for the years on the rate on the date on which the asset is bringing in your business. Now explanation number 677A is saying that suppose if in amalgamation and demerger, holding to subsidiary to holding. Amalgamation, demerger, holding to subsidiary to holding. So what will be the actual cost of asset? So here actual cost of asset will be WDV of the previous owner. So in simple part, whatever the WDV of the previous owner, that will be the actual cost for the, cost for the successor basically. Now explanation number 8 is saying that suppose if any asset is acquired out of the loan money, in that case whatever interest up to the date on which asset is actually put to use, that interest should be capitalized, and whatever interest paid after that, that will be allowed as revenue expenditure. Explanation number 9 is saying that excise duty, custom or GST is that will be forming part of your actual cost or not. So try to understand if SENVET credit or input tax credit is available, then it will not be forming part of your actual cost, but suppose input tax credit is not available, then it has to be added to your actual cost. Now explanation number 10 is saying that government grant or government subsidy. So government grant or government subsidy, you have to reduce from your actual cost. Suppose government grant received related to a specific asset, then directly from that specific asset you have to reduce the government grant. But suppose many time government grant is related to the project. Suppose you are starting the project of 100 crore and government is going to give you 30 crore as a government grant. So here project related government grant, that is the 30%. Suppose I purchase one asset for the 7 lakh, then what government grant I will reduce from that asset, that is 2,10,000, that is 30% of the 7 lakh. Now next explanation is explanation number 11. Now explanation number 11 is saying that this explanation is applicable only for the non-resident. And this explanation says that suppose if non-resident acquired asset outside India and that asset he was using outside India, now he is bringing that asset into India and he is going to use that asset in India for his business purpose. What I am saying that this section is applicable only for non-resident. Suppose non-resident acquired one asset outside India and he was using that asset outside India. Now he is started a business in India and he is going to use that asset in Indian business. Question is that what will be the actual cost here? So here actual cost will be whatever actual cost to NR minus notional depreciation. You have to reduce the depreciation on the assumption that if that asset were used in India, then what will be the amount of depreciation? Just reduce that depreciation. whatever remaining, that will be your actual cost. Here you have to take the depreciation rate of the respective year. Here you have to take the depreciation rate of the respective year. Now explanation number 12 is saying that suppose any stock exchange, earlier that stock exchange was AOP BOI and now it is converted to the company, then what will be the actual cost for company? Whatever WDV of a stock, the WDV of AOP BOI, that will be the actual cost for the company. Now try to understand explanation number 13. Explanation number 13 is saying that suppose if any asset on which 35 AD 100% deduction is already claimed, 100% deduction under specified business is already claimed, like you were using that asset for the specified business and now suppose you are transferring that asset to the non-specified business, and in a specified business you already have claimed the 100% deduction, or suppose you received that asset as a transaction not treated as transfer under section 47. Suppose you received that asset from a holding company to subsidiary company, or subsidiary company to holding company, or in the partition of HUF or amalgamation or demerger or succession. Suppose if you receive that asset and earlier assessee already claimed the 100% deduction under section 35 AD, that is specified business 100% deduction, by that person already claimed the 100% deduction. Now question is that what will be your actual cost? So here your actual cost will be nil. So in simple word, on any asset on which 100% deduction is already claimed under section 35 AD, and if you receive that asset under the transaction mentioned under section 47, then your actual cost will be nil because 100% deduction is already claimed. Now try to understand, many times there are various rules in the income tax, and as per that rule your income is partly agriculture and partly business income. When you engaged in the growing and manufacturing of tea, 40% is business income, 60% is agriculture. Growing and curing of coffee, 25% is business income, 75% is agriculture income. Growing, curing, roasting and grounding, in that case 40% is business income, 60% is agriculture income. In case of the growing and manufacturing of rubber, 35 is a business income, 65 is a agriculture income. So as per this rule, there is a rule of 7A, 7B, 7C and rule number 8. Now as per this rule, your income will be like 40, 60 and all. So guys, try to understand, if any assessee is having income partly from agriculture and partly from business, like that as per rule number 8, rule number 7A, 7B and 7C, then you have to calculate depreciation on the assumption that your total income is from business. Means whenever you will calculate the depreciation, then calculate depreciation on the assumption that your total income is from business only, and whatever depreciation computed, that depreciation is presumed actually allowed to assessee, and you have to reduce that depreciation from your block of asset, that depreciation from block of asset. Now try to understand, all people, just pay attention. In case of the SLM method can be followed only by the power generating and distributing unit. So if you follow the SLM method, then you have to follow the individual asset system. Suppose if you transfer the asset, then what will be the treatment? So guys, try to understand, if you transfer the asset and you are going to recover less than WDV, means your selling price is less than WDV, then whatever loss, that loss is known as the terminal depreciation directly debited to P&L account. Suppose for an example, your WDV was 80, suppose your cost was 100, you have claimed 10% SLM method depreciation for 2 years, so now your WDV is 80. Suppose you receive the 72, then 8 is a loss, that loss is known as the terminal depreciation directly debited to P&L account. Suppose you recover the 89, here 9 is a profit, that 9 will be directly credited to P&L account, and it is known as the balancing charge taxable under section 41 subsection 2. And suppose if you receive 117, your WDV was 80, your cost was 100, your selling price is 117. In that case, whatever recovery of 20, that is more than WDV but up to cost, that 20 will be treated as balancing charge only, and it will be taxable under the head PGBP. But whatever you earn more than cost, whatever you received more than cost, in excess of cost, so here in excess of cost is a 17, that 17 will be taxable under the head capital gain, and it will be always a short term capital gain due to section 50A. You got my point or not? Yes. So suppose if your sale price is less than WDV, then terminal depreciation debited to P&L account. Your sale price is more than WDV. Sale price is more than WDV but up to cost, it will be a balancing charge taxable under the head PGBP. Your sale price is more than cost, then it will be a short term capital gain. You got my point or not? Yes. Now next part is related to government grant and government subsidy. Guys, try to understand, if government grant and government subsidy is related to the is related to your asset, then obviously it has to be reduced from your actual cost. But suppose all other government grant and government subsidy will be taxable under the head PGBP. All other government grant and government subsidy will be taxable under the head PGBP if it is related to the business and profession. Now there are two exceptions. One is if any subsidy is related to the asset, then it has to be reduced from actual cost. And second, if any subsidy or government grant is received by trust or institution and that is created by central government or state government, and grant is received from the central government as a corpus fund, then it is not taxable. What I am saying, that any government grant or subsidy is received by a trust and trust is created by central government or state government, and that trust received government grant or subsidy from central government as a corpus of the trust, it is not treated as taxable. It is not taxable at all. Now this part I already explained you that interest paid up to the date on which asset is actually put to use has to capitalize, and after that directly debited to P&L account. Now if any asset is partly used for your business purpose and partly for other purpose, then obviously expenditure related to that asset like repair, maintenance, as well as your taxes, your insurance as per section 30, 31 and all, so that is allowed only depreciation and only allowed towards the use of the business. Means suppose 60% that asset is used for your business purpose, then all expenditure is allowed only to the extent 60%, means 40% is not allowed. Next section is 32 AD, that is called investment allowance. Now guys, try to understand investment allowance. This section is saying that the investment allowance is allowed to all assessee. Okay, if any person started a manufacturing business, in the notified backward area on or after 1/4/2015 in the notified backward area of the Andhra Pradesh, Bihar, Telangana and West Bengal, then 50% investment allowance is allowed on new plant and machinery. So suppose all people just pay attention, investment allowance, and this is the last year of this investment allowance. This section is saying that if any person means individual, HUF, company, partnership firm, any person, if that person start a manufacturing business on or after 1/4/2015 in the notified backward area of the Andhra Pradesh, Bihar, Telangana, West Bengal, and he acquired and installed new plant and machinery between 1st April 2015 till 31st March 2020. 1st April 2015 till 31st March 2020, he is eligible to claim the 15% investment allowance on that asset. 15% of actual cost will be investment allowance, means directly debited to the 15% directly debited to the P&L account. Now question is that, sir, when investment allowance 15% is allowed, sir, question is that depreciation and additional depreciation allowed or not? Answer is yes, depreciation and additional depreciation is allowed. Investment allowance is in addition to the depreciation and additional depreciation. And one more interesting part, depreciation and additional depreciation you have to reduce from your block of asset. You have to reduce from your block of asset, but investment allowance, there is no need to reduce from your block of asset. So there is basically extra benefit on investment allowance. And now try to understand, suppose asset is not put to use, then also investment allowance is allowed. Investment allowance saying that, this section is saying that only you have to acquire and install the plant and machinery. So suppose you acquired and installed the plant and machinery, then investment allowance is allowed at the rate 15% in the year in which that plant and machinery is installed. But there is a condition that that plant and machinery, whatever you acquired, you should not be transferred within 5 years from the date of its installation. You should not be transferred that plant and machinery within 5 years from the date of its installation. If you transfer, in that case, whatever investment allowance you have claimed earlier, that will be withdrawn and it will be treated as your business income in the year in which plant and machinery is sold. But there are some exceptions. In case of demerger or amalgamation or reorganization means succession. Succession means proprietor to company, partnership firm to company, or small company to LLP mentioned under section 47. In that case, it is not treated as transferred. But suppose if 3 years was already passed, then the remaining 2 years, that successor should not be transferred that plant and machinery. Now here also plant and machinery does not include the second-hand plant and machinery or plant and machinery used in the office premises or residential accommodation, or plant and machinery on which 100% deduction is already allowed under the head PGBP in the single year, or plant and machinery does not include the ship, aircraft or road transportation vehicle. Now try to understand, if a plant and machinery is not used but only acquired and installed, you are eligible to claim the investment allowance of 15%. If put to use less than 180 days, then also you can claim the 15% investment allowance. You got my point or not? Yes. So now next part is 33 AB and ABA. Next section is section 33AB and ABA. 33AB, first we are going to discuss section 33AB. 33AB deduction is available to the all type of assessee, means individual, HUF, company, partnership firm, all assessee. If that assessee is engaged in the growing and manufacturing of the tea, coffee and rubber in India. So if any assessee engaged in the tea, coffee or rubber in India, growing and manufacturing, then deduction under section 33AB is available. Now try to understand, deduction is available only if you deposit some amount in the NABARD. You have to deposit the sum amount in the NABARD. What is the time limit for deposit? You have to deposit the amount in the NABARD up to the due date of return filing or 6 months from the end of the previous year, whichever is earlier. Up to the due date of return filing or 6 months from the end of the previous year, whichever is earlier. Now what is the amount of deduction? Amount of deduction will be whatever amount you deposited or 40% of your business income. 40% of your business income before this particular deduction. Now try to understand here, business income means before segregating that 40-60, because whatever net profit comes, that we will distribute in 40-60, that agriculture and business and all. Before doing that, whatever the income, from that income, just take the 40% of that income and amount credited to the NABARD, whichever is lower will be your deduction amount. Now try to understand, section 33ABA is saying that 33ABA deduction is available only if assessee is engaged in the business of prospectation, extraction or production of the natural gas and petroleum in India, then that deduction is available. Now this deduction is available if assessee deposits some amount in the SBI or site restoration account up to the end of the previous year. Now guys, try to understand, in 33ABA the time limit is deposit is up to the end of the previous year. You have to deposit up to the end of the previous year in SBI or site restoration account. Now what will be the amount of deduction? Whatever amount you have contributed, whatever amount you have deposited, or 20% of the business income, whichever is lower. Now try to understand that whatever amount you have deposited in the NABARD, that amount you have to utilize as per the tea, coffee and rubber board scheme. And if you deposited in the site restoration account or petroleum natural gas, you have to utilize that amount as per the scheme framed by the Ministry of Petroleum Natural Gas, Government of India. Suppose if that amount is misutilized, in that case whatever deduction claim earlier, that will be withdrawn and it will be taxable in the year of misutilization. Now try to understand, all people, whatever amount you withdraw, whatever amount you withdrawn from site restoration account as well as the NABARD, that amount you have to utilize only in the year of withdrawal. Suppose amount is withdrawn on 28th March, then you have to utilize till 31st March, otherwise that will be treated as your income. Now try to understand, whatever amount you withdraw, you can utilize that amount for the revenue purpose as well as the capital purpose, but as per the scheme notified by the Tea, Coffee, Rubber Board or Ministry of Petroleum. Now you cannot use that money for the plant and machinery used in office premises or residential accommodation or for office appliances, but except computer, means you can acquire the computer or plant and machinery on which 100% deduction is already claimed. You cannot utilize that money for the plant and machinery on which 100% deduction is already allowed under the head PGBP in the single year. So all people just pay attention. Deposited amount you can withdraw and you can utilize as per the scheme framed by the Tea, Coffee, Rubber Board or Ministry of Petroleum Natural Gas. Now, that money you cannot utilize for three purposes. First, for acquisition of plant and machinery that is used in office premises or residential accommodation or any office appliances, but you can purchase the computer, it is okay, no problem. Or plant and machinery on which 100% deduction is allowed, you cannot purchase that plant and machinery. Now try to understand, suppose if you withdraw amount and you utilize as per a scheme for the revenue purpose, you are utilizing that amount for the purpose of like tea, coffee, rubber and all, they mention the purpose. You are rightly utilizing that amount. You are rightly utilizing that amount for a revenue purpose. Now question is that, can you claim that revenue expenses as a deduction in current year? Answer is no, because you are using that deposited amount. So whenever you were deposited that amount, that time you already claimed the deduction under section 33AB or ABA. So now if you are utilizing that amount and you utilize for the revenue purpose, then that revenue expenses is not allowed in the current year. But suppose you purchase the capital asset as per the scheme, and you utilize for the capital asset, can you claim the depreciation? Answer is yes, you can claim the depreciation, no problem at all. Now try to understand, suppose if you acquired any capital asset, then that capital asset should not be transferred within 8 years from the end of the year in which asset is acquired. Means within 8 years you should not transfer that asset. Suppose if you transfer within 8 years, then whatever deduction claim earlier in respect of that asset, that will be treated as your PGBP income, and on that asset there will be a capital gain. Now all people just pay attention. There is at the time of closure, if any amount is received from tea, coffee, rubber deposit account, like from NABARD, if you received any amount, and if it is received at the time of closure of business, then it is taxable. If it is received at the time of dissolution of firm, then it will be taxable in hands of the firm. If it is at the time of death of assessee or partition of HUF or liquidation of company, then it is not taxable. So suppose if you close that NABARD account, this is applicable only for 33AB. Suppose if you close that NABARD account and if you receive the amount on the closure of business or dissolution of firm, then it is taxable. So if you received at the time of the death of the assessee or partition of HUF or liquidation of company, then it is not taxable. You got my point or not? Yes. Now we are going to start with the scientific research. All people just pay attention. Section 35. Section 35 is related to the scientific research. In scientific research, first part is self-spending, or I can say that in-house research. Means you are doing the research for your own business, that is called your in-house research. So if you spend anything for in-house research, then deduction is allowed under section 35. Now all people, how deduction is allowed? So there are basically two parts. First is research during the course of business, and second is research before commencement of business. All people just pay attention, just pay attention. Just pay attention to my words only. All people just pay attention. So part A is the in-house research. In-house research means research for your own business. How much deduction is allowed? All people just pay attention. Two part. Research during the course of business means your business is also going on and you are doing the research. Like Ranbaxy business is going on and they are doing the research for the COVID vaccine and all. That is called research. Now try to understand research during the course of business. If you incurred any revenue expenditure, 100% deduction is allowed. But if it is capital expenditure, in that case only land deduction is not allowed, but other capital expenditure deduction is allowed at 100%. So all people just pay attention. If you do research and research is during the course of business, means your business is also going on and you are conducting the research. In that case, if you incur any revenue expenditure, 100% deduction is allowed. Capital expenditure except land, all other capital expenditure, 100% deduction is allowed. You got my point or not? Yes. Now try to understand. If research before commencement of business, means there is no business and you are doing the research. So question is that whatever expenditure incurred before commencement of business, is that deduction is allowed? Answer is yes, it is also allowed. Means any expenditure incurred before commencement of business on research, expenditure is allowed, but maximum 3 years before the date of commencement of business. Whatever expenditure incurred before 3 years, means up to 3 years from the before the date of the commencement of business expenditure, only that expenditure is allowed. In that also try to understand, in revenue expenditure, only salary and material expenditure is allowed at 100%. Only salary and material expenditure is allowed at the rate 100%. Only salary and material expenditure is allowed at the rate 100%. Other revenue expenditure is not allowed. And in case of capital expenditure, obviously other than land, all capital expenditure is allowed. But in salary also, in revenue expenditure, salary is allowed, but salary excluding the perquisite. Perquisite is not allowed as deduction. So all people just pay attention, just focus to my word. First part is related to the in-house research. In-house research means research for your business. There are two parts. First is during the course of business, revenue expenditure 100% deduction, capital expenditure except land, other expenditure 100% deduction. Before commencement of business, maximum 3-year expenditure is allowed. In revenue, only salary and material 100% allowed, and salary excluding perquisite. Other revenue expenditure not allowed. In capital except land, all other capital expenditure are allowed. Now try to understand. If research is carried on during the business and if 3 conditions are satisfied. Research carried on during the business and 3 conditions are satisfied. First condition, if assessee is a company, if assessee engaged in the manufacturing business or biotechnology business, and if that business is approved from prescribed authority, means that research is approved from prescribed authority, that is Science and Technology Department of Indian government, then you are going to get the 150% deduction instead of 100%. What I am saying, that 3 conditions are satisfied and research for your business and research is during the course of business. company engaged in manufacturing or biotechnology business and research is approved by prescribed authority, in that case you are going to get the 150% deduction instead of the 100% deduction, but except land and building. On land and building, deduction is not allowed under this section, but all other revenue and capital expenditure, deduction is allowed at 150%. So suppose if all the three conditions are satisfied, then on land obviously deduction is not allowed, but on building 100% deduction was allowed under section 35(1)(4). So on building you will take the 100% deduction, and all other revenue and capital expenditure you are going to get the 150% deduction. Now next part is related to contribution or donation to the outsider. Suppose you are making the donation or contribution to outsider, then also you can claim the deduction under section 35. First, if donation is made to the Rahul ICU, Rahul ICU means to approved Rahul ICU. Rahul means research association, I means institute, C means college, and U means university. If you make the donation to the Rahul ICU, R means research association, I means institute, C means college, U means university, and that is approved, and you are making donation for scientific research, deduction is allowed at the rate 150%. If they engaged in the social and statistical research and you made donation for the social and statistical research, deduction is allowed at 100%. Suppose you are making donation to the IIT or national laboratory, deduction is allowed at the rate 150%. If donation is made to any Indian company, that Indian company is engaged in research and development and donation is for scientific research, then 100% deduction is allowed under section 35(1)(2)(a). All people just pay attention. What I am saying that in this particular chart, you are making donation to the outsider. Means you are not doing any scientific research, other are doing the scientific research, and you are just making the donation or contribution. You can get the deduction. First part, you are making donation to the Rahul ICU, to approved Rahul ICU. Rahul means research association, I means institute, C means college, U means university. And you made donation for the scientific research, deduction is allowed at 150%. Social statistical research, deduction is allowed at 100%. If IIT National Laboratory for scientific research, deduction is allowed at 150%, and Indian company for scientific research, deduction is allowed at 100%. You got my point or not? Yes. Now next part is related to section 35 ABB, that is related to the telecommunication license. If any capital expenditure is incurred on the telecommunication license, then deduction is allowed over the life of the license. Deduction is allowed over the life of the license, but try to understand, deduction is allowed only if the payment is made. Deduction is allowed only if the payment is made. So in simple word, I can say that under section 35 ABB, if you incurred any capital expenditure to obtain the telecommunication license and payment is made, then deduction will be allowed from the year in which payment is made till the year in which license will expire. All people just pay attention. In telecommunication license, your deduction will be allowed from the previous year in which payment is made till the previous year in which license will expire. But try to understand, if license taken before commencement of business and payment is already made, license taken before commencement of business and payment is already made, then deduction will be allowed from the year in which business is commenced till the year in which license will expire. So in simple word, if your business is already in existence and you acquired any license, deduction will be allowed from the previous year in which payment is made till the previous year in which license will expire. But suppose if business is not there, you just acquired the license, business is not commenced and payment is already made, deduction will be allowed from the year in which business is commenced till the year in which license will expire. You got my point or not? Yes. And if you sell the license, then what will happen? That is same concept we have discussed in the terminal depreciation balancing chart. That same thing will happen here also. Now next part is 35 ABA. 35 ABA is saying that suppose if you made any capital expenditure for the purpose of obtaining the telecommunication spectrum, that is 4G, 5G, 3G and all, then all points will be similar whatever we have discussed in section 35 ABB. So in examination, if you see the telecommunication license, always 35 ABB, and telecommunication spectrum, then go with the 35 ABA. You got my point or not? Yes. Now suppose if there is an amalgamation or demerger, then remaining deduction will be allowed to the amalgamated or resulting company. You got my point or not? Yes. Now next part is related to 35 CCC. 35 CCC and 35 CCD two are similar section. Now 35 CCC is saying that if SSC engaged in the agriculture extension project, if you spent anything on the agriculture extension project, deduction allowed under section 35 CCC at the rate 150%. And if you engaged in the skill development project, and if you spent anything on the skill development project, deduction is allowed at the rate 150% under section 35 CCD. Now try to understand, in both the section, deduction is allowed at the rate 150% on all expenditure except land and building. Means on land and building deduction is not allowed, but on other expenditure deduction is allowed at the rate 150%. Skill development project 35 CCD, agriculture extension project 35 CCC. In both places 150% deduction except land and building. Now try to understand, first section 35 CCC is applicable to all assessee, but 35 CCD is applicable only to the company. This is one difference. 35 CCD is applicable only to the 35 CCD is applicable only to the company, but 35 CCC is applicable to all assessee. Now next part is related to the preliminary expenses. 35D. 35D is saying that preliminary expenses means expenditure at the time of the commencement of business and all, like preparation of the feasibility study or project report, market survey, engineering survey, drafting or printing of MOA, AOA, legal fees, expenses related to the public issue of the share or debenture, or other expenses may be notified by CBDT, that is called preliminary expenses. Now question is that, is preliminary expenses is allowed? Answer is yes. But try to remember, preliminary expenses is allowed only to the resident person. It is not allowed to non-resident. And preliminary expenses is allowed only if that expenditure is incurred at the time of the commencement of business, at the time of the commencement of business or extension of your existing business or set up a new unit. Means preliminary expenses is allowed only at the time of the commencement of business or extension of your existing business or set up a new unit. Then only preliminary expenses is allowed. Now try to understand, sir, preliminary expenses is basically restricted to the 5% of cost of project. Means preliminary expenses should not be more than 5% of cost of project. Suppose I can take an example, your preliminary expenses is 7 lakh. But your cost of project is a 1 crore. So 1 crore multiplied by 5% comes to the 5 lakh. So here 7 lakh, 5 lakh, whichever is lower is a 5 lakh. Only 5 lakh preliminary expenses is allowed, and that too not allowed in the single installment. It will be allowed in the 5 equal installment. So whatever preliminary expenses that is allowed in the 5 equal installment, you can claim the deduction of the preliminary expenses. So suppose 5 lakh is allowed, that 5 lakh will be allowed in 5 equal installment, means 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh. Now next part, all people just pay attention. For the Indian company, you can take the capital employed instead of cost of project. Means instead of cost of project, you can take the capital employed. So I can say that in Indian company, you will compare the cost of project or capital employed, whichever is higher than that should be multiplied by the 5%, and your eligible preliminary expenses, whichever is lower will come, you will consider the lower, and that lower will be allowed in the 5 equal installment. You got my point or not? Yes. Now next part is related to, sir, question is that, okay, what do you mean by cost of project? Cost of project means whatever investment in the fixed asset, of that project, that is called cost of project. Investment in the fixed asset for the new business or for the extension of existing business or for the setup of new unit. So for set up a new unit, what amount you invested in fixed asset, that is called cost of project on the last day in which that new unit is set up. Or suppose new business is started, so as per the balance sheet of the last day, what was amount was invested in fixed asset of that new business, that is called your cost of project. Capital employed means share capital plus long term borrowing plus debenture. Share capital plus long term borrowing plus debenture. Now try to understand, here capital employed does not include the reserve and surplus. So if there is a security premium, that security premium should also be excluded as per the case law of the Supreme Court in case of the Berger Paint. And in case of the Berger Paint, Supreme Court is saying that whatever security premium, that is also not part of the capital employed. You got my point or not? Yes. Now try to understand. Suppose if there is a amalgamation demerger, and suppose 3 installment is already claimed, then remaining 2 installment can be claimed by the new company, that is amalgamated company or resulting company. Now section 35DD is saying that suppose if there is any expenditure on the amalgamation and demerger, then you can claim the deduction in 5 equal installment, but this deduction is allowed only to the Indian company. So if there is any amalgamation or demerger expenses, deduction is allowed only to the Indian company in the 5 equal installment. In 5 equal installment, you can claim the deduction, but this deduction is allowed to the assessee who incurred the expenditure. Suppose amalgamated company incurred, then deduction is allowed to the amalgamated company in 5 equal installment. Resulting company, then resulting company. Demerged company, that demerged company. If amalgamating company incurred the expenditure related to amalgamation, then deduction is allowed to amalgamating company. But guys, try to understand, amalgamating company will able to claim only one installment. because after one installment amalgamating company will cease to exist. So in case of amalgamation, it is always advisable that amalgamation expenditure should be incurred by amalgamated company. So amalgamated company can claim the 5 installment. Now next section is 35 DDA, that is related to the VRS or voluntarily retirement compensation. This deduction is allowed to the all assessee. If you spend anything on the VRS, that deduction is allowed in the 5 equal installments. So suppose I can take an example during the corona. Suppose Air India given the VRS of the 10 employee and they paid the 50 lakh as a VRS compensation, so that 50 lakh will be allowed in the 5 equal installment, that is 10 lakh, 10 lakh, 10 lakh, 10 lakh, 10 lakh. Okay. Now next part, in 35 DDA, if there is a amalgamation or demerger or succession means company to, proprietor to company, partnership firm to company, or small company to LLP. So in case of the amalgamation, demerger or succession, in case of the VRS, suppose 3 installment is already claimed, now remaining 2 installment will be claimed by the new person. If after 3 years, suppose if there is an amalgamation, demerger or succession, then remaining installment will be claimed by the new person, and in the year of amalgamation, demerger, succession, in that year installment will be claimed by new assessee only. You got my point or not? Yes. Now next section is 35 AD. Next section is 35 AD. 35 AD is related to the specified section. Now this section is saying that in case of this 14 specified business, deduction at the rate 100% allowed on the capital expenditure also. Means revenue expenditure, obviously deduction is allowed 100%. But in this 15K businesses, your deduction at the rate 100% allowed in the capital expenditure also. So all people, what is the 14 business? All people just pay attention. First business is that is cold chain facility for the agriculture produce or fish product or meat product. Second is a warehousing facility for the agriculture produce. Third is a petroleum and natural gas pipeline. Next is related to hospital of 100 bed or more, or hotel of 2-star or above category, housing project under slum redevelopment or housing project under affordable housing scheme, production of fertilizer in India, beekeeping, bee honey and bee wax business. After that, container depot and container freight station. One is the warehousing facility for sugar, slurry pipeline for the transportation of iron ore, semiconductor wafer fabrication manufacturing unit, and new infrastructure facility. So there are basically 14 specified business, and this 14 specified business, 100% deduction is allowed on the capital expenditure. 14 specified business. First is a cold chain facility, warehousing facility for agriculture produce, petroleum natural gas pipeline, hospital of 100 bed or more, hotel of 2-star or above category, housing project under slum redevelopment and housing project under affordable housing scheme, production of fertilizer in India, beekeeping, bee honey and bee wax business. After that, that is warehousing facility of sugar, container depot, container freight station, slurry pipeline for the transportation of iron ore, semiconductor wafer fabrication manufacturing unit, and new infrastructure facility. Now question is that, sir, on capital expenditure 100% reduction is allowed. Question is that, is all capital expenditure is eligible for 100%? Answer is no. Except 3, all expenditure is allowed at 100% deduction. 3 exception is a land, goodwill and financial instrument. On land, goodwill and financial instrument, deduction is not allowed under this section. Now try to understand one more thing. Sir, there are some condition for this business. Answer is yes. There is first condition is that all that 14 business should be new business. It should not be split up or reconstruction of your existing business. If this business are new, then only deduction is allowed. Now next part is in this business, whatever plant and machinery you used, that plant and machinery should be the new. Means new plant and machinery is required, but 20% can be second hand. Exception is 20% can be second hand. Suppose if any hospital acquired the plant and machinery of 100 crore, out of that 20 crore can be a second hand. And second point, if any plant and machinery acquired from outside India, means imported plant and machinery on which deduction or depreciation not claimed under Income Tax Act 1961, even that is the second hand plant and machinery, that will be treated as new only for the purpose of this section. That plant and machinery will be treated as new only for this particular section. Now try to understand. For petroleum and natural gas pipeline business, there are some additional conditions. First condition is that petroleum natural gas pipeline business should be owned by Indian company or consortium of Indian company, means group of Indian company. Second is that business should be approved by the Petroleum and Natural Gas Regulatory Board, and that business will make some portion of the pipeline available for others as decided by the PNGRB. Means some portion of the pipeline should be made available for use by others also. Now for the new infrastructure facility also, there is a condition that company should be there, like that business can be done by only Indian company or group of Indian company, and there will be agreement with the state government or central government or any government authority regarding the new infrastructure facility. Then only deduction is allowed. Now all people, please pay attention. Here we are saying that 100% deduction is allowed on the capital expenditure. Now question is that expenditure incurred before commencement of business, then also it is allowed as deduction. Means any expenditure incurred before commencement of business, on that also 100% deduction is allowed in the year in which business is commenced. Now try to understand, sir, in the initial year, when you are claiming 100% capital expenditure as reduction, then obviously there will be the loss. So in case of the loss, if there is a loss under a specified business, that can be set off only against the specified business income. And if there is any losses remaining, then that can be carry forward for the unlimited number of years. Means you can carry forward like unabsorbed depreciation. You can carry forward for the unlimited years. So what I am saying that specified business loss can be set off only against specified business income. A specified business loss can be set off only against a specified business income, and if that any loss is remaining, that you can carry forward for the unlimited years. Now try to understand. A specified business loss you can set off against the specified business income only, but other specified business, that specified business is eligible for 35AD deduction or not, that is irrelevant. Now we can take one example. Suppose I am having one hotel in Mumbai, and that hotel is a 3-star hotel. I have started that hotel last year only, so it is eligible for 35AD deduction. Now that Mumbai hotel, and I am also having one hotel at the Jaipur, and that hotel was started 20 years ago. 20 years ago means that time this section was not there. So that time I started a 4-star hotel in Jaipur. Now question is that my Mumbai hotel loss, if there is a specified business loss, can I set off against the Jaipur hotel profit? Answer is yes, I can set off against the Jaipur hotel income, because Jaipur hotel is a specified business. That is the 4-star hotel, means 2-star or above category. That Jaipur hotel is not eligible for 35AD deduction, but that hotel is treated as the specified business. So my Mumbai hotel loss can be set off against the Jaipur hotel income. You got my point or not? Yes. Now try to understand one more thing. When 35AD deduction is allowed, then obviously depreciation is not allowed for that asset. Depreciation is not allowed for that asset, as well as any other deduction under chapter 6A under the heading C, that is a deduction in respect of any income, that is also not allowed if section 35AD is available. Now try to understand, after some time, suppose if you transfer any asset. Suppose if you transfer any asset on which you claim the 100% deduction under section 35AD, then whatever selling price, that will be taxable under the head PGBP. So if any asset on which you claim the deduction under section 35AD, and if you transfer that asset, then whatever selling price of that asset, that directly will be taxable under the head PGBP. You got my point or not? Yes. Now try to understand, all people. There is one restriction, and that restriction is saying that suppose if any asset is acquired for the specified business, that asset should not be transferred to the non-specified business. You should not transfer that asset to the non-specified business. You should not shift that asset to the non-specified business within 8 years from the year of acquisition. Within 8 years from the year of acquisition, if you transfer that asset to the non-specified business, means you are using that asset for non-specified business. I can take one example. Suppose I am having the two business. One is the coaching class business, and one is my hotel business. And hotel is a 5-star, 3-star, 4-star hotel. Now suppose I can take one example. I purchased one AC for the hotel. I claim the 100% deduction under the hotel, and after some time I just shifted that AC from my specified business to the non-specified business, that is coaching class. Now they are saying that you should not transfer that asset to the non-specified business within 8 years from the year of acquisition. If you transfer in non-specified business, then whatever deduction you have claimed earlier, that minus depreciation allowable if section 35AD is not there, whatever remaining amount, that will be taxable under the head PGBP for the specified business. What I am saying that all people just pay attention. If any asset which were used for a specified business, that should not be transferred to the non-specified business within 8 years from the year of acquisition. If you transfer in non-specified business, then whatever deduction claim earlier under section 35AD, minus depreciation allowable if section 35AD is not there. What depreciation you could claim if section 35AD is not claimed, then that depreciation will be reduced and whatever remaining amount that will be taxable under the head PGBP. Now try to understand, for non-specified business you will add that asset to your block of asset. What will be the actual cost? So actual cost will be whatever cost of acquisition of that asset minus calculate the depreciation on the assumption that if that asset were used for non-specified business from the date of acquisition, what would be the depreciation? Just reduce that depreciation and remaining will be your actual cost for the non-specified business. You got my point or not? Yes. 35 is your homework. Next section is 36. 36 is saying that certain deduction is allowed under section 36. So there are basically some deduction that is allowed under section 36. First is the insurance premium of stock in trade. Suppose you took the insurance of your stock in trade, that insurance premium is allowed, no problem at all. Suppose if you made health insurance of your employee, if you took a health insurance policy of your employee, is that premium is allowed? Answer is yes, that is allowed, but there is one condition that premium should be paid by any mode other than cash. Premium should be paid by any mode other than cash. Now next part is related to bonus and commission to employee. So bonus and commission to employee, if any bonus and commission is given to the employee, is it is allowed to the employer? Answer is yes, it is allowed as to the employer. Now question is that suppose bonus is paid more than the as per the bonus act. Means bonus act is saying that you have to pay the bonus act of one salary, but you are giving the 5 salary as a bonus. Is it is allowed as deduction or not? Answer is yes. Even that bonus is more than as whatever bonus decided by bonus act, if it is more than that, then also it is allowed as deduction. But try to understand, in bonus and commission to employee, there is an interference of one section, that is the 43B. 43B is saying that bonus and commission is allowed as deduction, but you have to pay that bonus up to the due date of return filing, otherwise that bonus is not allowed as deduction in current year. Means if you paid that bonus and commission to employee up to the due date of return filing, then it is allowed in current year, otherwise it will be allowed in the year in which actual payment is made. Now next point is related to interest on loan. Question is that, sir, interest on loan, if loan is taken for your business purpose, obviously interest is allowed. If loan is taken for your personal purpose, interest is not allowed. But if loan is taken for business purpose, interest is allowed. But try to remember one thing: if loan is taken from scheduled bank or public financial institution or a state financial corporation or a state industrial investment corporation or NBFC, then interest is allowed, but there is an interference of section 43B. 43B is saying that that interest will be allowed only if that interest is actually paid up to the due date of return filing, otherwise that interest is not allowed. But suppose if loan is taken from any other person, then interest is allowed even if that interest is outstanding. Now next point is related to discount on the zero coupon bonds. Zero coupon bonds is a bond which is issued at discount and redeemed at par. Suppose one bond issued at 80 and redeemed at par, that is called zero coupon bond. Now this 20 is called your discount, or we can it is like a interest only. So question is that this discount is allowed to the company or not? Answer is yes, that discount is allowed on the pro rata basis over the life of the bond. Whatever your bond tenure, bond life, first divide that bond life in the calendar month. First divide that bond life or tenure in the calendar month and try to understand, in any calendar month if there is a 15 days or more, that month will be considered, but in any calendar month if the less than 15 days, that month has to be ignored. Whatever month came, just divide your total discount by that month. That will be the 1 month discount, and that 1 month will be multiplied by the month falling in that particular year. That will be your total discount allowed in that particular year. You got my point or not? Yes, all people. Next part. Now employer contribution to the gratuity fund and gratuity fund as well as the provident fund and all. So question is that suppose if employer is contributed for the purpose of employee, it is allowed to employer or not? All people just pay attention. If employer contribution for the statutory provident fund or approved statutory provident fund or recognized provident fund or approved gratuity fund or approved superannuation fund or any fund under any other law, in that case it is allowed as deduction. But suppose if employer contributed for the unrecognized provident fund, that is URPF, or unapproved superannuation fund or unapproved gratuity fund, then it is not allowed as deduction. So all people please pay attention. Employer contribution towards the SPF, RPF, AGF, ASF, it is allowed. But employer contribution towards the URPF, UASF, UAGF, then it is not allowed as deduction. Now try to understand, if employer contribution towards RPF, SPF, ASF, AGF and fund as per any other law, it is allowed as deduction, but there is an interference of the section 43B. 43B is saying that it is allowed as deduction only if the actual payment is made up to the due date of return filing, otherwise it is not allowed as deduction. Now next point is related to, suppose employer contributed something for the employee in the national pension scheme or new pension scheme or central government pension scheme, is deduction is allowed to employer? Answer is yes, deduction is allowed. But what will be the deduction? Whatever actual contribution or actual contribution of employer or 10% of salary, but salary include only basic salary and DA in terms, whichever is lower will be the deduction allowed to the employer. So employer made the contribution to the new pension scheme or central government pension scheme or Atal Pension Yojana, you can say that, for the purpose of employee, then deduction is allowed to employer whatever contributed amount or 10% of salary, whichever is lower, whatever contributed amount or 10% of salary, whichever is lower. Now next part is related to, suppose all people just pay attention, many times you know that employer just deducts some amount from employee salary for the purpose of PF or ESI and all. So whatever amount held by employer, means it is a collected from employee. So whatever employee contribution collected by employer from employee, that amount employer has to pay to the that respective fund up to the due date of that fund. Otherwise that will be treated as the income of employer. What I am saying, that whatever amount collected by employer from employee, that has to deposit to that respective fund up to the due date of that fund, otherwise it will be treated as the income of the employer, means up to the due date of that fund. But there is one case law of the AIML Delhi High Court judgment, and Delhi High Court judgment is saying that even that amount is deposited after the due date of that fund but before the due date of the return filing, it will be allowed as deduction, means that will not be treated as income. But for examination purpose, always if it is deposited after the due date of that fund, you have to treat that as an income of the employer. Now next part is related to animals used in the business but other than stock in trade. Suppose if any animals used in the business but other than stock in trade, on that animals you can claim the deduction only in the year in which that animal is died or become the permanent useless. What will be the amount of deduction? Whatever your cost of animal minus scrap value. Next part is related to bad debts. Question is that is bad debts is allowed or not? Answer is yes, bad debts is allowed. But bad debts is related to the sales, then only it is allowed. If bad debts is related to the loan, it is not allowed. Provision for bad debts is not allowed at all. So provision for bad debts not allowed. Bad debts related to sale, it is allowed. Bad debts related to loan, it is not allowed. But suppose if assessee is engaged in the money lending business, suppose assessee engaged in the money lending business, then bad debts related to loan also allowed as deduction. Now guys, try to understand, you can claim the bad debts if two conditions are satisfied. First condition, that debt should be treated as your income. For claiming the bad debts, only two conditions are satisfied. First condition, that income should be treated as your income in the current year or any earlier year. And second condition is that while claiming the bad debts, you have to write off your debt. You have to write off your debt. Now try to understand, there is one exception. Many times what happens, as per the ICDS, you recognize the income. But as per the books of accounts, as per the Ind AS, as per the accounting standard, you have not recorded any income. Try to understand. Many time in ICDS, there is an earlier recognition of the income. So as per the ICDS, suppose you disclose the income, but as per the accounting principle, as per Ind AS and AS, you have not disclosed the income. Suppose after some time, that income is bad debts. That income is bad debt. So first condition is that should be treated as your income. Yes, but second condition was that you have to write off the debt. But question is that in books of accounts, you have not passed any entry. In your books of accounts, in your AS, in your Ind AS, you have not recognized that asset, like income. How you can write off? So they are saying that even you will not write off, then also it is okay. You can claim the bad debts. Now bad debts recovery will be taxable in the year in which it is recovered, whether you are having that business or not. So bad debts recovery will be taxable in the year in which it is received or recover. Now try to understand, if bad debts was claimed by partnership firm and it is recovered by the partner, then it won't be taxable in hands of the partner, because bad debts recovery will be taxable only in hand of the person who claimed the bad debts. So in this example, if bad debts is claimed by partnership firm and it is recovered by the partner, then it won't be taxable in hands of the partner. Next section is a provision for bad debt. Section 36(1)(7)(a). Provision for bad debts is allowed only to the banks. And what will be the percentage of provision for bad debts? So for Indian bank, provision is allowed at the rate 8.5% of the GTI before this deduction, as well as the 10% of the aggregate average advance made by the rural branches. That 10% of aggregate average advance made by the rural branches, that is allowed only to the Indian bank. Now next part, in case of the foreign bank or public financial institution or state financial corporation or state industrial investment corporation and NBFC, and foreign bank only allowed at 5% of the GTI. Now try to understand, when provision is debited to P&L account, then whatever your actual bad debts, that actual bad debts will be debited to P&L account or provision account. Right answer is provision account. When provision is already debited to P&L account, then actual bad debts will be debited to the provision account. Suppose if your actual bad debts is more than provision, your actual bad debts is more than provision, then whatever excess actual bad debts, that will be directly debited to P&L account, that will be allowed in the P&L. You got my point or not? Yes. Family promotion expenses, family planning expenses, promotion of family planning expenses, it is allowed only to the company. If it is revenue expenditure, allowed 100% deduction. If it is a capital expenditure, allowed in the 5 equal installment. Next part is the CTT and STT. So security transaction tax and commodity transaction tax is allowed to a person who is engaged in the share or commodity trading business. So if you are engaged in the share or commodity trading business, in that case, that CTT and STT is allowed as deduction. Next part is related to the transfer to the special reserve. Now try to understand this transfer to the special reserve provision. This provisioning, or you can say that this transfer to a special reserve is allowed only to the, this is, wait a minute, this is allowed, no, I have to again go to that particular page. Transfer to the special reserve. Now, if financial corporation is engaged in the long-term funding, long-term finance, if financial or corporation, they are engaged in the long-term funding means if any loan which is going to repay only after 5 years, minimum 5 years, only after minimum 5 years, that is called your long-term finance. So if any financial corporation engaged in the long-term finance and they create any special reserve, then deduction is allowed under section 36. What will be the amount of deduction? All people just pay attention. First is the actual amount transferred to the special reserve. Second is 20% of PGBP income. PGBP of the core activity of the finance. Means 20% of the PGBP income is PGBP income here means whatever the core activity, finance activity, PGBP income of that 20%. And third is the 200% of the share capital and general reserve minus the opening balance of that reserve. Whichever is lower will be your deduction amount. But if you withdraw from that special reserve, then withdraw amount will be taxable again. You got my point or not? Yes. Next part is related to purchase of sugarcane. That is only for cooperative society. If cooperative society is engaged in the sugar manufacturing and they acquire sugarcane at a rate lower than whatever rate decided by government, then also that expenditure is allowed as deduction. Now next part is related to mark to market losses. Is mark to market losses is allowed or not? So try to understand mark to market losses if that is computed as per the ICDS. Just you have to remember that mark to market losses is as per ICDS, then it is allowed as deduction. If it is not as per ICDS, then it is not allowed as deduction. Next section is section 37, that is called general deduction. If any expenditure which is not covered under section 30 to 36, that will be allowed under section 36. 37 if three conditions are satisfied. First condition is that expenditure should be wholly and exclusively for your business purpose. Second condition, that expenditure should be in the revenue nature. And third condition is that expenditure should be legal expenditure, then only it is allowed as deduction. Next part is related to, sir, is CSR expenditure is allowed? Social responsibility, that corporate social responsibility expenditure as per section 135 of the Companies Act, whatever CSR expenditure incurred by companies, sir, is it allowed under section 37? Answer is no. Here law is saying that CSR expenditure is not a business expenditure, so it is not allowed as deduction. Next part is related to advertisement expenditure is allowed. Answer is yes. But try to understand, if advertisement in the newspaper, pamphlet, brochure or any manifest of the political party, then it is not allowed as deduction. Gift to employee allowed as deduction, no problem. Customary expenses or Diwali Puja expenses, New Year Puja expenses, inaugural expenses, that is allowed as deduction. Now dividend and DDT is not allowed as deduction because it is a appropriation of profit and direct tax. Now next part is related to, sir, share and debenture issue expenditure is allowed or not? If share and debenture issue expenditure is covered under preliminary expenses, then you will claim the deduction under section 35D. But suppose if that expenditure is not covered under preliminary expenses, then that will be allowed under section 37 or not. So now try to understand, if any expenditure is incurred for the IPO purpose, for the IPO purpose or FPO purpose or right issue, then it is treated as capital expenditure, not allowed as deduction. Means share or debenture issue expenditure related to the IPO, if you are going to raise the capital, IPO or FPO or right issue, then it is not treated as revenue expenditure, means it is treated as capital expenditure. It is not allowed as deduction. But suppose if you are going for the buyback of share, or bonus share or debenture and loan, then whatever expenditure incurred at the time of the buyback or bonus or debenture or loan, that will be treated as revenue expenditure. You can claim the deduction. This is decided in one of the case law of the Brookbond India Limited. That court is saying that IPO, FPO and right, you are going to raise your capital will change, so that's why it is a capital expenditure. But at the time of buyback, bonus and debenture, your capital will be intact, means capital will not change. That is called your revenue expenditure. Now question is that taxes is allowed or not. So obviously direct tax is not allowed. Direct tax is your personal expenditure, it is not allowed, but indirect taxes is allowed. Interest on direct tax is not allowed, interest on indirect tax is allowed, but penalty is not allowed at all. Penalty related to direct tax as well as indirect tax is not allowed as deduction. But now try to understand, there are two type of the penalty: penalty for breach of law and penalty for breach of contract. A penalty for breach of law, then it is not allowed, but penalty for breach of contract is allowed, but contract should be of the revenue nature. If there is a penalty for breach of contract, it is allowed as deduction, but contract should be of the revenue nature. Next part is related to, you know that many times pharmaceutical company gives the freebies or free gift to the doctor and all. Is that will be allowed to the pharmaceutical company? Answer is no, it is an illegal expenditure. Or sometimes there is a one case law of the CAPSCAN laboratory. So laboratory give the referral commission to the doctor to refer the patient to that laboratory. Is that referral commission is allowed? Answer is no, that is also illegal expenditure. It is not allowed as deduction. You got my point or not? Yes. Now next section is section 40. And section 40 is amount specifically not deductible. They are saying that there are some amount or some expenses which exclusively not allowed as deduction. First section is section 40, clause A, subclause 1A, is saying that suppose if any payment is made to non-resident, or account credited of that non-resident, and if you not deduct the TDS in current previous year. If you not deduct the TDS in current previous year or deducted the TDS in current previous year, but not deposited to government up to the due date of your return filing, in that case your 100% of expenditure will be disallowed. If payment is made to non-resident or account is credited of non-resident, if TDS is not deducted in current previous year or deducted in current previous year but not deposited to government up to the due date of return filing, in that case 100% of that expenditure will be disallowed. So in simple word, I can say that if payment is made to non-resident or account credited of non-resident, then that expenditure is allowed only if TDS is deducted in current year and deposited to government up to the due date of return filing. Otherwise that expenditure will not be allowed as deduction. Now try to understand, suppose if TDS is deducted in subsequent year, or TDS deducted in current year but deposited after the due date of return filing, then that deduction will be allowed, that expenditure will be allowed in the year in which payment is made to government. Now next point is related to section 48, clause 1 is saying that if any amount is paid to resident person or account credited of resident person, and if TDS is not deducted in current previous year or deducted in current previous year but not deposited to government up to the due date of return filing, then 30% of such expenditure will be disallowed. If in case of non-resident 100% was disallowed, in case of resident only 30% is disallowed. Suppose if it is deposited in subsequent year, then it will be allowed as deduction in the year in which that TDS is deposited to the government. All people just pay attention, one more interesting part. Suppose if payment is made to non-resident or payment is made to resident and TDS is not deducted. So TDS not deducted, then obviously in current year it will be disallowed, means 30% or 100% will disallowed. Now try to understand. But that payee, non-resident or resident, that payee is very honest. That payee included that amount in his income. Payee paid the taxes, whatever due on that income. Payee filed the return. And you have obtained one certificate from chartered accountant in form number 26A. In that case, it is presumed that you have deducted the TDS and paid to government on the date on which that payee furnishes return of income. What I am saying that, suppose a payment is made to non-resident or resident, but you have not deducted the TDS, so obviously 30% or 100% will be disallowed in current year. But that payee is very honest. Payee included that amount in his income. Payee paid the taxes due on that income. Pay file is written off income and you have obtained one certificate from chartered accountant of this particular effect. In that case, lawmaker is saying that it is presumed that you have deducted the tax and paid to government on the date on which pay furnishes written off income. So in simple word, in current year, your 30%, 100% will be disallowed and that amount will be allowed in the year in which pay furnishes written off income. You got my point or not? Yes. Now next section is section 48 clause 2A, clause A, subclause 2B. This section is saying that if any state government charge any fees, privilege fees, etc. from a state government undertaking exclusively, then it won't be allowed. It will not be allowed to the state government undertaking as a deduction. Now next point is saying that suppose if any salary paid outside India or salary paid in India to a non-resident, all people just pay attention, salary paid outside India or salary paid in India to any non-resident, then you have to deduct the TDS. You have to deduct the TDS and you have to pay that TDS to government up to the due date of TDS. Due date of the TDS means 7th of the next month. You have to deposit that TDS to government up to the due date of the TDS. Otherwise, that salary will be disallowed. Means that expenditure will be disallowed 100%. And even if you pay from your own pocket, then also it is not allowed as deduction. Even if there is a delay of 1 day, then also it is not allowed. This is very rigid provision basically. And this provision is saying that if you make any payment of salary outside India to any person or in India to a non-resident, then you have to deduct the TDS and deposit that TDS to the government up to the due date of TDS. Otherwise, that expenditure is not allowed as deduction. If you deposit even late by single day, then also that expenditure is not allowed as deduction. Now, next point is related to section 48 clause 5. 40 clause A subclause 5. Tax on non-monetary perquisite. So, many times you know that employer pay the taxes on non-monetary perquisite of employee. Now, that non-monetary perquisite tax is exempt in hands of employee due to section 1010 CC. Now question is that can employer claim the whatever tax paid by employer on the non-monetary perquisite? Answer is no. It is not allowed as deduction. Now next section is related to 40A subsection 2. This section is saying that if any payment is made to the relative, then it will be allowed only to the extent reasonable. Means whatever excess payment or like reasonable payment will be disallowed, only reasonable payment will be allowed and it will be determined by the assessing officer. Now question is that what do you mean by the relative? For individual, relative will be the spouse, mother, father, brother, sister, lineal ascendant and lineal descendant. For HUF, member and their relative. For partnership firm, partner and their relative. For company, director and their relative. For AOP BOI, member and their relative. Now try to understand, if any person means individual, HUF, AOP BOI and all, if that person and there is someone other person, if that person is having substantial interest in that business or that person is having substantial interest in the assessee's business, in that case both are treated as the relative. Suppose one holding company is having the two subsidiary company, then subsidiary company will also be treated as the relative. Now next point is related to section 40A subsection 3. Now section 40A subsection 3 is saying that in a single day to a single person, if you're making the any payment, then it should be made by more than 10,000, then it should be made by the account pay check, account pay demand draft, any mode of electronic clearing system through bank account or any other electronic mode as may be prescribed. Means in the single day to a single person, if more than 10,000 payment is made in cash, then that expenditure will be disallowed. But if payment is made to transporter, then that limit will be 35,000 instead of the 10,000. But basically guys, there are some exception. In that exceptional cases, you can make the payment in cash. If payment is made to the RBI, LIC, bank or government, then you can make the payment in cash, no problem at all. Suppose if there is a book adjustment, then it won't be treated as the cash payment. Book adjustment means suppose you are demanding 10 lakh from me. So like 10 lakh is credit and 15 lakh is due from you. So 10 lakh is due from me and 15 lakh is due from you. So we are just setting up that 10 lakh. So question is that 10 lakh set up or book entry will be treated as cash payment? Answer is no, it won't be treated as cash payment. Suppose if payment is made to the producer of the agriculture product or fish product or meat product or animals and all, in that case cash payment you can make, no problem at all. Or suppose payment is made on the day when banks are closed. Payment is made on the day when banks are closed, you can make the cash payment, no problem at all. Or for retirement benefit, you can make the cash payment of the 50,000. Means for retirement benefit, 50,000 rupees cash payment is allowed. Suppose you are making the payment of salary to your employee and employee is not at a normal place of his duty. He is going to somewhere else for the more than 15 days or more, then in that case you can make the cash payment of the, you can make the cash payment to that particular employee. Suppose payment is made in a village or a town where bank facility is not available, then you can make the cash payment. Suppose you are an authorized money changer, means your work is, you are engaged in the money changing business, then obviously you can make the cash payment, no problem at all. Now next section is section 48, subsection 7 is saying that provision for gratuity is not allowed as deduction. Provision for gratuity is not allowed as deduction. Now try to understand, in gratuity, if actual gratuity is paid, that is allowed as deduction. Approved gratuity fund, it is allowed as deduction. Or if any provision is made for the current year gratuity. Current year gratuity means whatever gratuity due in current year. Suppose in current year your 10 employee are retired. So for 10 employee gratuity is already due. So that is called current year gratuity. So current year gratuity provision is allowed. For any future year provision, that is not allowed as deduction due to section 48 subsection 7. You got my point or not? Yes. Now next section is section 43B. 43B is related to this section interfere at various places. So this section is saying that the following expenditure is allowed only if the actual payment is made of that expenditure up to the due date of return filing. Otherwise that expenditure is not allowed as deduction in the current year. That will be allowed in the year in which actual payment is made. So all people please pay attention. This section is saying that this expenditure will be allowed in the current year only if actual payment of that expenditure should be paid up to the due date of return filing. Otherwise that is not allowed in the current year. It will be allowed in the year in which actual payment is made. First is any tax, duty and cess. Second is a bonus and commission to the employee. Third is the employer contribution towards the SPF, RPF, AGF, ASF, approved gratuity fund, approved superannuation fund, or any fund under the any law, or that is the new pensions scheme. That contribution, employer contribution, should be allowed only if it is actually paid up to the due date of return filing. Next is if loan is taken from the schedule bank or PFI or SFC or SIIC or NBFC, then interest is allowed only if it is actually paid up to the due date of return filing. Now try to understand, schedule bank include the cooperative bank also. Schedule bank will include the cooperative bank also. Next is the leave salary. Next part, any sum payable to the railway for the use of the railway asset. Any sum payable to railway for the use of railway asset. Now try to understand, interest on NBFC is included from current year only. Interest on NBFC is included from current year only under this particular section. Now try to understand, there is one clarification. Suppose for an example, if on NBFC interest, earlier deduction was already claimed on accrual basis. Now in the current year you are going to make the payment of interest. So question is that, is again deduction will be allowed? Answer is no. Obviously deduction is allowed only once. Now try to understand. So in simple word I can say that these all expenses are allowed only if payment is made up to the due date of return filing. Otherwise that expenditure is not allowed in current year. Next part is related to 43CB. This section is saying that in case of the construction contract and service contract, what I am saying that just remember, in case of the construction contract and service contract, your revenue has to be recognized on the basis of percentage of completion method. Means you have to follow the POCM method, percentage of completion method. On the basis of percentage of completion method, you have to recognize the revenue. But there are two exceptions. First is if any your service contract is not more than 90 days. Means service contract duration is not more than 90 days. In that case, your revenue has to be recognized on the basis of project completion method, or I can say that completion method or total completion method. So in case of the service contract, that duration of that service contract is not more than 90 days, then revenue has to be recognized on the basis of the project completion method. Next part, if any service contract involve the indeterminate number of acts over a specific period of time, then revenue has to be recognized on the straight line basis, or in simple word I can say that on the time basis you have to recognize the revenue. Now try to understand, in case of any contract, your contract revenue should include the retention money. So if there is any retention money, that retention money should be part of the contract revenue. And if there is any incidental incidental income like dividend or interest or capital gain and all, that will not be reduced from your contract cost. In accounts, what you do, you know that from contract cost you reduce the incidental income, but you should not reduce for the purpose of income tax. Next part is the section 43D. 43D is saying that suppose in case of the banks or PFI or SFC or SIIC or NBFC, suppose if there is any NPA, asset is NPA means as per the RBI rules and all. So suppose if any loan is given by bank and that loan is now NPA. So on NPA, when interest income will be recognized? So here this section is saying that interest on that NPA asset should be recognized only in the year in which either that interest is credited to P&L credit side or received by that bank, whichever is earlier. So interest on NPA, non-performing asset, that will be interest will be recognized only at the time when that interest is either credited to P&L account or received by bank, whichever is earlier. Next section is 43C. 43C is saying that suppose if there were any capital asset and that capital asset is transferred under amalgamation or partition of HUF or gift or irrevocable transfer. In case of amalgamation or gift or partition or HUF will irrevocable transfer, if that capital asset is transferred as a stock in trade for receiver. That asset is a stock in trade for receiver. So question is that what will be the cost of acquisition of that stock in trade? So here cost of acquisition will be whatever cost of acquisition for previous owner, as well as the improvement done by previous owner as well as current owner, that will be added for the cost of acquisition of a stock in trade. Now next section is 43A. 43A is saying that suppose if asset is acquired from outside India, if asset acquired from outside India on the foreign currency loan or supplier credit, what I am saying that on foreign currency loan or supplier credit, then at the time of the payment, only at the time of payment of that foreign currency loan or supplier credit, if there is any foreign exchange fluctuation gain or loss, that foreign exchange fluctuation gain or loss should be adjusted with your actual cost, or in simple word I can say that should be adjusted with your block of asset. So suppose if there is a foreign currency loan, then it has to be added to your block of asset. If there is a gain, then it has to be reduced from your block of asset. Now next section is section 43AA is saying that foreign exchange fluctuation gain other than that section 43A, other are allowed or not, that is allowed only as per the ICDS. So if suppose ICDS is saying that foreign exchange fluctuation gain or loss allowed, then it is allowed, otherwise it is not allowed and taxable. Not allowed or not taxable if it is not covered by the ICDS. Now next part is related to section 41. 41 is related to the deemed PGBP. First section 41.1. 41.1 is saying that suppose assessee claimed any expenditure deduction. If assessee claimed the deduction of any expenditure and suppose now he got the remission or refund of that expenditure, or suppose that liability ceased to exist, trading liability ceased to exist, in that case that will be taxable under the head PGBP. What I am saying that suppose you claim any expenditure as a deduction and now suppose you got the refund of that expenditure, that will be taxable under the head PGBP. Or suppose you claim any expenditure and there is a trading liability and that trading liability ceased to exist, in that case that will be taxable under the head PGBP. Now question is that sir, suppose if there is a waiver of any loan, it will be taxable under the section 41.1 or not? So if there is a waiver of the working capital loan, then section 41.1 is applicable, but there is any other loan, section 41.1 is not applicable. Now question is that sir, any interest was outstanding from bank and now that interest is waived off, is section 41.1 is applicable? Answer is no. In case of interest waive off, section 41.1 is not applicable, because when interest was outstanding, then you could not claim that deduction due to section 43B. So obviously deduction was not claimed, so there is no need of the section 41.1. Next section is 41.2, that is related to the balancing charge. I already explained while I was explaining the depreciation. 41.3 is saying that sale of scientific research asset. Suppose any capital asset, any asset basically which were used for the purpose of scientific research. Now after scientific research, that asset you are selling. Now there may be a two case. First, you are using in your current business, and after that you will sell. So suppose if you used in your business, then it has to be added to your block of asset at nil value as per the explanation 1 of section 43.1. But suppose directly you are selling from laboratory. Any asset which were used for scientific research, you are selling directly from your laboratory. In that case, whatever your selling price or deduction claim under section 35, whichever is lower will be taxable under the head PGBP, and if your selling price is more than cost, then there will be a capital gain. Now section 41.2 balancing charge we already discussed, and recovery of bad debts we already discussed. Section 44AA is a books of accounts, is a homework. 44AB is a compulsory audit of your books of account. So audit is mandatory in case of business your turnover is more than 1 crore in previous year. Audit is mandatory in case of profession. If your turnover is more than 50 lakh, audit is mandatory. Now under section 44AD or ADA, if you disclose the income less than 8%, 6% or 50%, And if your net taxable income is more than basic exemption, then you are required to maintain books of accounts and get it audited. And suppose under section 44AE, 44AE is a transporter, and 44BB and 44BBB, you are declaring your income less than the prescribed percentage given in those section, then also you are required to audit your books of accounts. Now audit can be done only by chartered accountant. Audit due date is the 30th September of assessment year, and if you have not audited your books of accounts, then there will be a penalty under section 270B, and penalty will be the 0.5% of turnover or gross receipt or 1,50,000, whichever is lower. Now next section is presumptive basis taxation. Very important section 44AD. 44AD is saying that presumptive basis taxation, this section is applicable for resident individual, resident HUF and resident partnership firm. If any person is resident individual, resident HUF, resident partnership firm, but not applicable to the LLP. This section is saying that if assessee engaged in the business but not profession, not a commission brokerage business, not a agency business, or not a business of transporter, so they are excluded. Basically 4 type of the business, means profession excluded, 44AE business, transporter excluded, commission agent, commission brokerage kind of business is excluded, and agency business is excluded. So suppose if any assessee, that is resident individual, resident HUF, resident partnership firm, engaged in the business and his turnover is up to 2 crore, then his PGBP income will be directly 8% of the turnover or gross receipt. Means 8% of the turnover or gross receipt is his PGBP income. But try to understand, if your turnover is realized by account pay check, account pay demand draft, any mode of electronic clearing system through bank account or any other electronic mode as may be prescribed up to the due date of return filing, then you can apply 6% instead of 8%. Means there will be a 6% instead of 8% if your turnover is realized, by account pay check, account pay demand draft, any mode of electronic clearing system through bank account or any other electronic mode as may be prescribed up to the due date of return filing. So suppose in current year, suppose I am having one business and my turnover is 80 lakh. Out of that 50 lakh is a cash turnover and 30 lakh is a account pay check turnover. So in that case, on 30 lakh there will be a 6% and on remaining 50 lakh there will be a 8%. Now question is that can assessee declare the more income? If assessee wants to declare more than 6%, 8%, can he declare? Answer is yes, he can declare, no problem. So if assessee declare the 8%, 6% or more than 8 and 6%, then there is no need to maintain the books of accounts and get it audited. But now try to understand, if assessee wants to declare the income lower than 8% or 6%. If assessee wants to declare the income lower than 8% or 6%, can he declare? Answer is yes, he can declare the income lower than 8% or 6%. But if he declare the lower and his net taxable income is more than basic exemption, then he is required to maintain books of accounts and get it audited. Now question is that when section 44AD is applicable, sir, is advance tax is applicable? Answer is yes. Assessee is required to pay advance tax only in the one installment, that is the 15 March 100% advance tax. Sir, from this profit, 8% profit, is any expenditure under section 30 to 37 is allowed? Answer is no. Expenditure is not allowed. As well as partner remuneration, partner's interest is also not allowed, because this section is override section 28 to 43C. Now try to understand, there is one interesting part. This section is saying that suppose in 1 year you opted section 44AD. Then for next 5 years, you have to opt section 44AD. Means in 1 year, you have opted the section 44AD. Then for next 5 years also, you have to opt the section 44AD. Suppose in next 5 years, there is any year, there is a violation or assessee not opted 44AD. So suppose in this year, assessee not opted 44AD. Then for this year, assessee not opted 44AD. Then for next 5 years, he is not eligible to opt section 44AD. And if his net taxable income is more than basic exemption, then he is required to maintain the books of accounts and get it audited also. You got my point or not? Yes. Next section is 44ADA. 44ADA is saying that if any resident person is engaged in the profession, he is the professional basically, and his gross receipt is up to 50 lakh, then his PGBP income will be whatever gross receipt multiplied by 50%. His PGBP income will be gross receipt multiplied by 50%. Now, can he declare the 50%, more than 50%? Answer is yes, he can declare. But can he declare the lower? If he want to declare the lower and his net taxable income is more than basic exemption, then he is required to maintain books of accounts and get it audited. Whatever expenditure given in under section 30 to 38 is not allowed as deduction. He is required to pay the advance tax. There will be only one installment, that is the 15 March 100%, and whatever remuneration or interest paid to partner by partnership firm, that is not allowed as deduction. Next point is related to section 44AE. First thing, this section is applicable to all assessee, means individual, HUF, company, partnership firm, AOP, BOI, resident, non-resident, it is applicable to all assessee. This section is saying that suppose if assessee is not having more than 10 vehicle at any time during the previous year, means maximum you can have the 10 vehicle during the previous year, then your income from that vehicle will be, in case of the heavy vehicle, your income will be 1000 per ton, 1000 rupees per ton per vehicle per month or part of the month. What I am saying that 1000 per, in heavy vehicle, 1000 rupees per ton per vehicle per month or part of the month. But in case of the other vehicle, your income will be the 7500 per vehicle per month or part of the month. Now try to understand, heavy vehicle means any vehicle having the gross vehicle weight of more than, any vehicle having the gross vehicle weight of more than 12,000 kilogram, or I can say 12,000 ton, that is called heavy vehicle. So heavy vehicle means any vehicle is having the gross vehicle weight of more than 12 ton, that is called your heavy vehicle. So in case of heavy vehicle, your income will be 1000 rupees per ton of gross vehicle weight or unladen weight. Now they have given the gross vehicle weight and unladen weight both. So question is that what we have to consider. So there is a CBDT clarification. CBDT is saying that if gross vehicle weight is available, then you have to go with the gross vehicle weight. If gross vehicle weight is not available, then you have to calculate on the unladen weight. You got my point or not? Yes. Now try to understand. Sir, can assessee declare the more than that income? Answer is yes, assessee can declare. But suppose assessee wants to declare the lower income. Suppose assessee wants to declare the lower income, then assessee is required to maintain books of accounts and get it audited. Assessee is required to maintain books of accounts and get it audited. Now try to understand, from whatever income calculated as per this provision, whatever income calculated as per this provision, out of that income, expenditure under section 30 to 38 is not allowed. But whatever remuneration and interest paid to partner, that is allowed as deduction under section 40B, means 40B deduction is available here. Now next part is some presumptive basis taxation for the non-resident. Non-resident, first presumptive basis taxation is section 44B. Now 44B is applicable to non-resident. This section is saying that if non-resident engaged in the shipping business, if non-resident engaged in the shipping business, then what will be his PGBP income? So his PGBP income will be whatever freight or amount he received in India or outside India, in India or outside India, for carriage of passenger from any port in India. What I am saying that he has to pay the tax on the amount received by non-resident or his agent in India or outside India from carriage of passenger, goods or mail from any port in India. Means if it is shipped in any port in India, if it is loaded in any port in India, then money is received in India or outside India. Whatever money received for the any goods or passenger shipped at any port in India, that will be taxable in India. And if anything is shipped outside India and if the amount is received in India, then that will be taxable in India. So whatever, guys, try to understand, whatever amount he received in India or outside India for goods or passenger or ship that is shipped at any port in India, and if amount received in India for the shipped from outside India, or that amount will be multiplied by 7.5%. Here 7.5% will be his PGBP income for non-resident engaged in the shipping business. This is the section 44B. Now 44BB is saying that suppose if non-resident is engaged in the aircraft business, operation of the aircraft, then there will be the 5% instead of 7.5%. Other provision are same, there is a 5% instead of the 7.5%. Now try to understand one thing. Section 44B and 44BB are mandatory section. Means suppose assessee income is less than 5% or 7.5%. So can he declare the lower than that? Answer is no, he cannot declare the lower than that. This section are fixed section or mandatory section. Now next section is section 44BB. Now 44BB is saying that suppose if any non-resident is providing some service or they are supplying the plant and machinery for the extraction, production or prospectation of the mineral oils. So non-resident is providing service or they are basically giving the plant and machinery on the rent, and that plant and machinery is related to the prospectation, extraction or production of the mineral oils. In that case, what will be their income? So whatever amount they received in India or outside India for activity carried in India, or they receive the amount in India for activity carried out outside India, on that amount multiply by 10%, 10% will be the PGBP income. Last section 44BBB and 44BBB is saying saying that this section is applicable in case of the foreign company. If any foreign company is engaged in the civil construction and they are going to engage, like making one turnkey project in India. Turnkey project is basically a project related to civil construction and all. We can take an example of the bullet train project. So suppose if any foreign company is engaged in India in the bullet train project and they have made the agreement with the government, what will be their income? So whatever amount they received, that will be multiplied by 10%. 10% will be the PGBP income. So 44B, in case of the shipping business, 7.5% is PGBP income. Aircraft business, 5% is PGBP income. That service related to the production, extraction of minerals and all, and supply of the plant and machinery, 10%. And 44 BBB turnkey project in case of 10% will be PGBP income. Now try to understand this last section, 44 BB and 44 BBA. In this two section, if your actual income is less than 10%, and then can you declare the less than 10%? Answer is yes, but for that you're required to maintain books of accounts and get it audited. You got my point or not? Yes, there is one small section, 44C. Suppose any non-resident is having Indian branch. Indian branch will prepare the P&L account as per normal provision. Now Indian branch will debit all expenditure and credit all income of that branch. Now suppose if there is any head office allocation expenses, head office allocates some expenditure to the branch. So question is that, is head office allocation expenses will allowed to the branch? Answer is yes, it is allowed to the branch. What will be the allowed amount? 5% of the adjusted total income or actual head office allocation expenses, whichever is lower, is allowed to the Indian branch. But question is that, what do you mean by the adjusted total income? So here adjusted total income is total income. Calculate the total income, but before taking the under chapter 6A deduction, means I can say that the gross total income, and gross total income also before claiming the benefit of the brought forward depreciation and brought forward losses. So I can say that the GTI before the claiming the brought forward depreciation and brought forward losses, that is called your adjusted total income. Suppose current year adjusted total income is a negative, then you have to take the 3 years average. But suppose all 3-year average comes to negative, then obviously there is not head office allocation expenses will not be allowed in the current year. Now section rule number 9 is related to film producer. You can read in the homework. So this is, guys, completion of your PGBP topic. Approx there is 2 hours, and in 2 hours we have discussed the topic PGBP. So guys, just listen this lecture 2, 3, 4 times, and after that directly go to the compiler, directly solve the question. Hope so you can complete all the questions, and all the best for your examination, guys. You know that now there is only 60 days is remaining, approx 60 days is remaining for your examination. 60-70 days approx. Give your 100% and just focus to your examination. There is only, like, you know that your target should be like that, if there will be a one student clear in examination, then you should be that student. So guys, give your 100%. I always say that give your 100%. Then ICI will give you the 50%, and we need only 50% to crack the exam. So please focus on study. You know that environment is not that much good, obviously. Like there is a negativity and all in the market due to the COVID situation and all. But guys, that situation is for everyone. Many students are still hoping that November exam will be cancelled, but I can give you in the written on the stamp paper that November exam will be there. November exam will not going to cancel. So guys, please focus for your November exam. Many people think that no, due to corona, and you know that IIT exam is going to conduct, all other exam is going to conduct, every state government is conducting the exam and all. So guys, November exam, there will be a November exam. So just focus to your study, give your 100% to your study. So thanks a lot, people. That's enough from my side. Thank you. Thanks a lot.